Welcome to today's deep dive. I'm your host, and we're getting right into the pretty high-stakes world of Central European real estate development today.
Right, and I'm your resident equity analyst. It's really a fascinating space because it's a world where a company's entire fortune can hang on just a single future project.
Exactly. So today we're taking a close look at Warimpex AG. They are a Vienna-based developer listed in both Austria and Poland. We are basing our analysis today on an equity research update from East Value Research, which dropped on December 4th, 2025.
Yeah, and our mission for this deep dive is to unpack what is essentially a tale of two markets for them.
Right. You have struggling hotels in Germany on one side and booming offices in Poland on the other. Plus, we'll analyze this massive bet they are placing on a residential project in Krakow to basically save their 2028 bottom line.
So looking at the current state, it is definitely a mixed bag. The first 9 months of 2025 were, well, honestly, pretty disappointing compared to forecasts.
Yeah, the hotel segment in particular really took a hit. Revenues there dropped 29%.
A huge drop. And it's largely tied down to one specific property, which is the Greet Hotel in Darmstadt, Germany.
Because they lost that city contract for housing Ukrainian refugees, right?
Exactly. You lose that guaranteed government income, and then you compound it with a very weak German economy where business travel just hasn't bounced back to fill the rooms.
Which puts them under severe financial strain. I mean, their net debt increased to 145 million euros.
Right, and the concerning part for you as an investor looking at this balance sheet is the net gearing ratio. It hit 212.1%.
That is heavily leveraged. I mean, for anyone not looking at these metrics daily, that basically means you are carrying more than twice as much debt as your own equity.
It is very high risk. But there's a bright spot we need to talk about, and that is the Polish office market.
Which is an entirely different economic reality right now. Real wages in Poland are growing over 4%, and GDP growth is expected to hit between 3.2 and 3.5%.
And that macro growth translates directly to their rental business. Strong demand and really tight cost discipline actually helped Warimpex beat year-over-year operational comparisons there.
Even if they missed the broader analyst targets overall. So Poland is essentially the engine keeping the lights on for the whole company.
It is. But their future relies almost entirely on a new venture called MOG31.
The Savior Project in Krakow.
Yes. It is a massive development. We are talking over 8,100 square meters of premium apartments and retail space.
They secured the building permit in October 2025, but the catch is it won't be completed until the end of 2027.
Right. And here is the accounting quirk you have to keep in mind. Analysts actually lowered their 2025 and 2026 profit estimates specifically because of this timeline.
Because international accounting standards mean the profits can only be booked upon completion in 2028 when they actually hand over the keys to buyers.
Exactly. They have to spend the cash right now to construct the building, but they cannot recognize any of that revenue yet.
But when they finally do, the revenue is forecast to jump from about 23 million euros in 2026 to a staggering 176 million in 2028.
It is a massive financial cliff.
Yeah.
But we definitely have to talk about the risk involved in actually getting to that 2028 payout.
Right, because the plan is to finance 80% of this project with debt. With a gearing ratio already sitting over 200%, that feels like doubling down on danger.
Yes, and it is a major concern for the analysts, especially since you have to factor in that the Krakow market is stabilizing rather than booming right now.
Right, housing prices there only rose 0.8% recently, so you are banking heavily on a market that is currently somewhat flat.
Which is exactly why East Value Research cut their 12-month price target down to 1.02 euros.
So the main takeaway here is that Warimpex is essentially treading water right now.
Completely. They are relying entirely on those steady Polish office rents and really hoping for interest rate cuts to ease the burden.
Right, those rates are expected to drop to 3.5% in Poland, which acts as their bridge to 2028.
It is the only bridge they have.
So here's a final provocative thought for you to mull over. With gearing well over 200%, and profitability pushed all the way out to 2028, is Warimpex a cleverly disguised value play on Polish growth?
Or are they a company dangerously over-leveraged on a single future deadline?
Because if a simple labor shortage or supply chain issue pushes that completion date into 2029, you have to wonder what happens to that mountain of debt. Thanks for joining us on this deep dive.